get to OPEC in a minute because I thought we had a scoop, Bob, but then they went out and put out a press release on this exact same thing. Let's start with why oil is not higher. Is it because of lack of retaliation? Is it because the Saudis have a couple million spare barrel capacity? Is it because of U.S. record high production, or D, all of the above?
Good to be with you, Brian. You know what? The market is complacent about geopolitical risk. If you don't see barrels going offline, like we saw with Libya recently, the impact doesn't matter much. It's boy who cried wolf, and they're tired of it. And I think they're hoping and expecting perhaps Israel will be restrained in its response and that we won't see a material disruption in the energy production and flows. Like you said, 20% of world gas comes out of Ras Laffan, out of that region. And then you've got 33% of crude loadings and 17% of product loadings come out of that region. But the market's saying, nope, it's been a year now. Boy who cried wolf. I'm not going to worry about it until I see actual physical damage.
Okay, and let's hope this de-escalates for the world's sake, for Israel's sake, for everybody's sake. Let's hope it de-escalates. But the other day, we watched Israel light up a Yemeni port and oil import facility. Yemen dropped one bomb on Israel, on Tel Aviv, and Israel just lit up the entire port. If Israel were to do something similar with Iranian either nuclear infrastructure, I know it's not oil, but you get my point, or some kind of oil infrastructure, which I'm sure the White House is strongly deterring them from doing. But if they were to do that, Bob, then what?
If Israel hits critical infrastructure from Iran, like oil facilities, major oil facilities, Karg Island, its nuclear complex, I believe that would trigger a regional war and put all of the production and flows that they're at risk. And we will be up. We'll measure the increments, Brian, in $10 a barrel crude. Israel is in three eyes for one eye mode here, as you just mentioned with Yemen. However, we expect not just the Biden administration pleading and so forth. They may take it a little easier on the first retaliatory package. I think it's going to be suppressing air defenses, hitting munitions, command and control, kind of working over Iran, preparing the ground if they have to go back in future strikes. So I'll be a little surprised if they throw that big a roundhouse punch here in the first retaliatory package. It'll be bigger than April, but I don't think it'll be that big.
Bob, as investors think through this, there's been a lot of value to find, so to speak, in a lot of the energy stocks. A lot of that is, maybe you can tell me, is predicated on higher oil, but not all of it. You know, at levels where we are, it seems like some of these names should still be attractive. I mean, where would you be looking to position in the oil and the natural gas space right now for the next couple of months?
I think we are in a once-in-a-generation opportunity to buy unloved oil and gas assets. And the real big inflection point will come when, and it is when, the world realizes we're not on a track to peak demand for oil and gas by the end of the decade. Now, between now and then, Kelly, we could have an air pocket. Macro is awful. China is awful. We're going to talk about OPEC Plus. If there's some discipline required, we could see lower levels. But I think we should position to buy with both hands for a multi-year boom cycle. Again, the main driver being EVs aren't coming fast enough. ICE cars aren't coming fast enough. The politicians aren't willing to push fast enough. And demand is not about to peak. When that surprise hits, we're all going to realize we're structurally short hydrocarbons in the medium term. That's the big play in my view.